This is the second part of Chapter 14 and covers how do you record the retirement of bonds. Two things can happen with bonds. First, the investor can hold them to maturity. The second is that they can be retired early by repurchasing them on the open market. And you may do this because suddenly the corporation has the cash, or maybe they can get more favorable interest rates. When the bonds are retired at maturity, the only amount on the book should be the bonds payable, and fair market value should equal the book value. Therefore, if you had $1 million in bonds payable at maturity, the journal entry should be bonds payable and cash. If, however, you're retiring by repurchasing, then what you need to do is make sure you take all of the transactions associated with the bonds you're retiring off the books, which include the portion of the bond issuing cost, any discounts or premium, or any accrued interest. So now let's take a look at this example. And now again, when I approach a problem like this, the first thing I look at is what are they asking me to do? And they're asking me to do journal entries first on April 1st when the bonds are issued. They also want me to journalize the first interest payment. They want me to accrue at December 31st, and then on March 1st, they want me to repurchase 6,000 bonds. So first thing I need to do is write down, again, what you always want to do is write down the pertinent information on a piece of paper to help you solve the problem. You should do this whenever you're working the problem. So the first thing I need to know is when were they issued. Second, what I need to know is how many bonds were issued, what's the stated rate, and for how long. These are 15-year bonds because that's going to tell me what I use to amortize a discount or premium. Next, I'm going to look at what were they issued at. In this case, they were issued at less than face because it's 97, which is less than 100%. The payment dates for interest are April 1st and October 1st, and we're using the straight line method. Also, on March 1st, we have repurchased 6,000 of the bonds, and we did this via issuing 2,000 shares of stock with a $10 par and we paid any accrued interest, which would be another journal entry we'd have to make, and we know the fair market value of the shares on March 1st, which tells us we're going to have some additional paid-in capital when we do our journal entry. So first, you need to write all that information down that I've highlighted because that's going to give you everything you need in order to answer the questions and prepare the journal entries. I'll give you a few seconds to do that. And then we'll move on to working the problem. Now again, whenever you're working these problems in the book, what you always should do is first look at what are they asking me to do, because particularly in intermediate and advanced accounting, when you have a problem, they give you more information than you need to solve the problem in order to confuse you, because let's face it, in real life, when you have a problem, you don't really know all the information you need. So first thing you should do is look at what are they asking me to do, and then second, find the pertinent information. Okay, the first thing you want to figure out is how much cash did we actually receive. So it's going to be the number of bonds times the face of the bonds times the percentage quoted. And that gives us 14,550,000. Now, how much cash do we have to pay back? In this case, it's 15,000 bonds times 1,000, so we have to pay back 15 million. Now, since the cash that we have to pay back is less than the cash we're receiving, it means we're going to have to debit discount on bonds when we do our journal entry. So now we can go ahead and do our journal entry. First, I always do the easy entries first, the entries I know. So bonds payable is going to be 15,000. Shares times $1,000 gives us the $15,000 that we're going to book. Then we're going to book the cash received, And remember, the discounted premium is always a plug. And in this case, since we sold the bonds for less than what we have to pay back, we have a discount on bonds, which also means that our interest expense is going to be higher. So what we also want to do in this particular case is when we figure out the amortization, we want to do it on a monthly basis, mainly because in the problem it says that we retired some of these bonds between interest periods. And we have to accrue at year end. So in this case, we probably want to know the monthly amount and the amount for every 6 months. Okay, what does our October 1st interest payment look like? Well, first, the cash is going to be the $15 million, which is the face of the bond, times the stated rate divided by 2. So the interest payment cash is going to be $825,000. The discount in bonds is going to be the monthly amount times 6, which is $15,000, and we add those two together, and that gives us our interest expense. Because we're using the straight line method, interest expense is a plug and it's always last. Now we have to accrue at December 31st, and in this case we're only going to accrue interest payable for 3 months. So we're going to take the 15 million times 11% divided by 12 times 3 months, and then the discount on bond is going to be the 2,500 times 3 months, and we add those two together and we get again our interest expense. Our next step is we have to record the payment of the interest on March 1st, which would be 5 months. So first, determine what percentage of the bonds were sold. In this case, 40% of the bonds were sold, 6,000 divided by 15,000. Second, determine the premium amortized each month for the 6,000 bonds. So we take the 2,500 times 40% gives us $1,000. Now we can do our journal entry to book the interest at the point of sale of or repurchase of those bonds and how much interest would apply that we would pay out. So the cash would be 6 million times 11% divided by 12 times 5 months. The discount in bonds would be 1,000 times 2 months. The interest payable would be 40% of the amount we accrued at year end. And the difference would be interest expense. I guess this is always a plug when we're using the straight line method. And we get that 412,500. That's the amount we accrued at December 31st. And that was represented 3 months, and we now are retiring it 5 months in. Now, the last thing we're going to do is journalize the sale of those bonds. First, we determine the unamortized discount associated with the 6,000 bonds. We're going to, the amortization per month is 2,500 times 180 months minus 11 months that we've already amortized times 40%, and that's going to equal 169,000. So of the total amount that we're going to amortize that we have left, we're going to take $169,000 off the books. So bonds payable is going to be 6 million. The discount on bonds that we're taking off the books is 169,000. Then we're going to book the common stock, which is $10 par times 200,000 shares, gives us 2 million. And the difference is the $31 minus the 10 gives you $21 times the 200,000 gives you 4.2 million, and then our plug is going to be loss on redemption of bonds. Now, I wanted to include some insights based on the latest rulings based on the international standard and show you some similarities. As indicated in earlier parts, GAAP and the international standard have similar liability definitions. We now classify them as current and non-current instead of current and long-term. Much of the accounting for bonds and long-term notes is also the same. Under GAAP and the international standard, bond issue costs are netted against the carrying amount of the bonds. They're no longer treated as an asset. Under GAAP, companies are permitted to use the straight line method. In the United States, we can use the straight line method if there's no major difference between that and the effective interest rate. However, we prefer that you use the effective rate. Under the international standard, you can only use the effective rate. And then here's what's on the horizon.